So to continue where we were regarding stocks, so you can see that, again, I don't mean to poo-poo everything these guys are saying, but for most of us, growth stocks are probably going to be a fair amount of our portfolio. And so when you're looking at total return, you're usually looking at just the capital gains. If there is a dividend that's paid, you would have to calculate that in there too to figure out how much you made on that. And then to make this also correct, that total return, if you're paying a broker to sell you this stock, you would have to factor in that commission. Now, again, if you're doing this correctly, that commission should be negligible. That commission, really, if you're paying more than $8 a trade, you're kind of doing it wrong. Sometimes people think, well, I'll get expert advice from a professional broker, and I have done that before, and it wasn't so professional. I don't think I've ever executed a trade through a broker where I have not gotten a letter about whatever, 1 to 2 years later, asking me if I want to be part of about a class action lawsuit about Payne Weber or whoever over-representing the stock because they had a position in the company. And so they'll say, oh, this is the new's greatest thing. This is what you got to get involved in. And then you come to find out it wasn't legitimate advice. So, I sure enough, I signed off on the class action lawsuits. Whether they're valid, I never quite ran it to ground. But anyway, those sorts of things are rife. And professional brokers, the problem that we have is again, I generalize everybody here in the room or on the lecture, is that we're not the high wealth individuals that are going to have a personal broker spending a lot of time over our accounts, because we don't represent that. We aren't moving around billions of dollars. So if you want good research, you're probably going to have to get it from other sources, but it can be done. Plenty of services out there. Again, Morningstar and some of the others, Standard & Poor's type stuff, where you can look at reports, you can look at advice, and again, use common sense. If it's a company that doesn't make sense, then don't track it. Like I say, the railroads right now, that ship has kind of sailed. Those things are pretty profitable. I don't know if you guys are tracking this whole thing in Missouri, but one of the students involved, his father was vice president of one of the railroads there in Omaha, making $8.4 million a year in annual salary. Anyway, his son is a student there in Missouri. So some people in the railroads are making out quite well. In terms of annualized holding period, again, if you're just doing this top calculation, total return equal dividends minus capital gain, that's not necessarily going to be annualized, right? How much did you make per year? Well, that's where you have to do it, using the equation where you're going to divide out the number of years. So to say you made 8% in a stock investment is only part of the equation. If you made 8% in a day, that's annualized rate. If you could replicate that, which you probably can, would be phenomenal. 8% over the course of 3 years, 2.5, whatever. You're not exactly killing it, and you're going to get taxed as well. So keep in mind, any of these capital gains are exclusive of tax. Again, going back to the real estate issue, might be one of the reasons why, if your portfolio has got real estate in it, especially one that you own, then you can roll that over. There's also some interesting things, too, that are kind of beyond the scope of this class. We'll talk about them. We'll just mention them. But in real estate, you can also do exchange-type things to postpone paying your taxes till later. So if you have an investment property, you can sell it, roll it into another piece of property within certain limits, like getting it into a like piece of property within 90 days, and you can postpone paying the taxes and stuff. Those things don't necessarily exist in the stock market, which is a drag. Come on. Always. All right. I mentioned beta last week. I don't have a problem with volatility, as long as it's biased, fairly even, going up and down. But having a stock that's kind of zinging around can make things interesting. If it's singing downwards, that's not always good. But if it's a high beta stock, which typically growth stocks will be, that's not bad. Right now, the market's down again today. It was down yesterday, so this could be shaping up to be a rotten year for stocks in general. But anyway, if you're looking at beta, and again that has to do with the volatility of the stock, the S&P, since it's compared to the S&P, is S&P would have a beta of 1. Something with a beta like 0.6 would be less volatile than S&P, and something with a beta of like 2 or 3 is highly volatile, 2 to 3 times as volatile as the S&P. Book value per share, assets, liabilities, shares outstanding. Again, this is a measure that's used, and it depends again on the kind of stocks you're buying, but a lot of times technology type stocks and other forward stocks, ones that are expanding, don't necessarily do too well in these tests because, again, you're buying stocks based upon future appreciation. This is a measure of current value. So, and you need to look a little bit deeper. I'm not saying to discount this entirely, but, you need to know more than just a few little facts. You need to, I'm much more concerned about the prognosis of this company in the future rather than a snapshot of their past. Market to book ratio, so market value per share, book value per share. Again, stocks can certainly be overvalued, but it has to do with the assets versus the market value out there. So if their assets say are, you do the math and their book value per share is only like $15, but yet they're trading for 22 or something like that. You need to ask yourself, why is the market putting more value on them? And again, it's kind of like the customer is always right. The market is generally right. If you're going against the market, you need to have a good idea why. Why is this thing out of sync? Why does the market think it's worth more? And stocks, trying to price stocks will often drive you nuts. Things like, the economic outlook came out great today, and also the stock price drops, and you're like, how can that be? Well, it's because the smart people in the market expected it to be even more positive, and it was a little less than what they thought, or they've already factored this in, or anyway, there's a number of factors where if you're going to trade individual stocks, you really have to be pretty astute and know all the factors. It's not as simple as sometimes it would appear. So a lot of things, again, kind of beg the conclusion that maybe buying mutual funds and a buy and hold strategy, doing dollar cost averages is probably where you want to be, and kind of get on with your life and concentrate on other things. Some of these trading individual stocks, I think it's good to do a little bit just so you understand kind of how the market works, but you probably don't want to have your life savings in there when you're kind of experimenting and figuring things out. So, investment theories, they put forward a couple of them, but again, future earnings is the key. So fundamental analysis is kind of what we've already talked about, value determined by the company's futures earnings. So that is a smart way to do it. Financial strength of the company, type of industry, new product development, economic growth of the overall economy. So again, that's kind of where I would take it from. Technical analysis, sometimes these guys will, there's people who are like chartists who will do nothing but look at charts, and they'll look at patterns and they'll be able to, or try to interpret where a stock is going just based upon charts, and it's devoid of what's going on with the company, what are their new products, and a lot of other things. So that's kind of a gut check, not expected on expected earnings, or not based on expected earnings or intrinsic value, but rather factors found as a market as a whole. So Yeah, I'm not a big proponent of this. I actually did subscribe and received all kinds of charts, and I was trying to get involved in futures, but anyway, I was smart enough not to put any real money in it. I did it just, making some kind of bets on paper just to see how I would have done. And sure enough, in the futures market, you can lose money. You haven't invested yet. You can lose a lot. But if you're doing options are again, we talked about that in a previous lecture. Options, you can just let the option expire worthless. Futures, if you let out a futures contract, become involved in one of those transactions, you've got to follow that transaction through until it's over, and that can be quite costly. Efficient market theory. This one is just kind of throwing up your hands, saying things are purely random, impossible for any investor. So if you're a big fan of efficient market theory, then the argument would be, why are you even, impossible for an investor to outperform the average stock market as a whole. Would sort of be the index investor, or just somebody who's just more or less hands off. So again, I think you can see from what we've talked about, the only one that really makes sense, at least to me, is the fundamentalist. How stocks are bought and sold. So primary market, this is buying directly from the company. Doesn't happen very, very often at all. And if it does, when I buy stock from a certain company, I get a 5% discount. So that's why I buy it. I mean, just because I have to, if I buy from the company, I have to hold it for 6 months, but I get a 5% discount on it. All things being equal, and that's a big what if, given the state of the stock market, but I should make 5% more. So, but it's pretty uncommon. And companies, that are corporations like, General Electric or, General Motors, something, they're in the business of buying cars or, running other things in their core competency. And so to get involved in direct stock sales, they may do a small portion of it. But for the most part, everything is going to be ran through an investment bank. So investment banks are kind of the market makers. The General Motors or somebody will want to raise capital. They'll go to one of these investment banks and they'll make a stock offering, and that investment bank will take care of that. So we talked about IPOs, initial public offerings. This is when a company's going, full up for the first time, and these are kind of sad for small investors because you oftentimes, this is, Twitter or something like that. I want to be involved. I want to, jump in there. Well, it's just the rules are such, and it's legal, where they only open this up to some of their more valued investors, and they're buying in large chunks, and you usually can't get the stock for anywhere near what those institutional investors will get it. You have to wait till it gets to the secondary market before you can get a crack at it. So the secondary market, though, is where things are for the vast point traded. So when you go on to Scottrade or E-Trade or call up a broker or do whatever, you're buying shares from somebody else generally, and it's going to be on the secondary market. But it's very efficient. It's well run, and it makes things very liquid. It's not like selling a house. The stock price is based upon, basically like anything else, what somebody's willing to pay for it. So if something is valued at $50 a share, the reason it's valued at $50 a share is there's somebody out there in the market who's willing to pay $50. It won't pay 51 right now. They'll pay more than 49. So anyway, $50 is the point. So when you execute the trade, if you go at market, that person who's got that open order out there for $50 will get you your shares, and that's how it works. But it's done in milliseconds, and it's often done in automated sections. But you, as the seller or buyer, you're, like I said, when you're buying stocks, you're buying in even amounts, a certain number of shares. So 36, 38, whatever. It doesn't have to be, round 50 or 100, lots of shares, whatever works for you, but not fractional numbers. Because, again, it's all done through the security exchanges in computers, and so those odd numbers don't trigger them, but the decimals are just not something they're going to deal with. The significance of some of these security exchanges is, and the guys with the coats trading in pits and calling out prices, that's kind of going by the wayside. A lot of, like NASDAQ, for example, is an over-the-counter kind of exchange where, it's just a virtual exchange. There's not a NASDAQ trading pit. Some of the commodities are still traded like that, but no, it's much more automated, and that's how. I mean, people just can't keep up with the number of trades that are executed and the amount of time that they're done in. It's just more efficient to have it automated. It's a bit more dangerous, but that's the way it happens. So when you see that OTC, over the counter, right, is what that means. And NASDAQ, National Association of Security Dealers, whatever, their exchange, the electronic one. 3,200 stocks, more than that now, but NASDAQ is often where a lot of the stocks I buy are found. But anyway, I don't go on to, when you go to buy a stock, let's say you're going to buy whatever, Ford or Lululemon or whatever, they're obviously, you may not know this, but they're traded on a different exchange. Ford being a big, behemoth, been around forever, they're going to be on the New York Stock Exchange. Lululemon's going to be out there on NASDAQ or something like that, because more of a, upstart kind of company. And but you don't have to know that, and nor do you care. You just get in there, you say, a ticker symbol, which you can find on Google if you don't have it, but you type in LU, 50 shares, and then you tell it whether you want market, spot, whatever, different prices, and boom, you execute that trade. A couple potatoes, comes back with a trade confirmation, and then a couple, 3 days later, the accounts settle out. You own those shares from that moment. But let's say you sell something, it's not like they're going to cut you a check and you can transfer that money right now. Generally, there's about a 3-day settling period before you have access to the cash. Sell stocks not listed on security exchanges. So, I would argue NASDAQ itself is a security exchange, but it just doesn't have a physical exchange. Brokerage firms, account executives. So, believe it or not, if you really want to talk to a account executive regarding a trade, you can, even with the cheaper ones, but they may boost up your commission you're going to get charged, maybe $50, $75, something like that, but they don't really, it's like doing a travel reservation online. If you actually want to speak to a travel agent, they don't do a whole lot more for you. They just charge you a little bit more. But somewhere involved in the execution is some sort of licensed individual who just kind of, sees your transaction, but not a big deal. Again, though, the notion that these, account executives and brokerage firms, that they've taken a personal interest in you is, I've just never found that to be the case. Again, if I was a high wealth kind of person, involved in private banking, maybe they'd, show me a little bit more love. But anyway, like I say, without fail, every trade, I was in the Middle East at the time, so, I was out of sync with the markets. The internet wasn't existent, or at least not that good. And so I was kind of at their mercy and trusted these guys, and they didn't rip me off that badly, but they didn't give me good advice either. So, and that's kind of why those things are gone. Discount brokerages versus full service. So the advice bit, I'm not saying to not do advice, but I can read as well as these guys can. So if I can find the source documents, I'm more apt to trust them. And again, what I'm looking for is Standard & Poor's, Morningstar, other financial documents. Nearest office and toll-free phone number. I'm not really all that concerned. I've never physically walked into one of these guys' offices. Everybody's got a phone number, and whether it's toll-free or not, most cell phone plans don't care. Obviously, it's going to have online. The phone trading, I don't like that. I've done it before, but it's just easier. The internet makes it so much easier to graphically see it. In the fees, charges, commissions. Like I say, it should be about $8. So, a little more, a little less. But But again, if it's more than that, because that's coming directly out of your earnings on that trade. So transactions, I'll go through these three real quick. So a market order. Let's say again in that example, I'm about to trade some stock, right? So I'll go to a website, and normally it's getting better now, but they usually, because they can actually sell the real-time quotes, they usually have those behind some sort of paywall. But anyway, you're getting a quote that might be delayed, a couple minutes or something like that, the free trades. If you go to like Yahoo Finance or something like that, you can find sites now that actually give you real time. But anyway, it's usually not that critical, because it's a cent or two is not going to make a big deal for me. But let's say that I'm looking at the market, I decide I want to buy. It's trading for right about $50. That's what the last trades were executed at. Most every online brokerage I've used lately, once you put in the initial part for the buy order or the sell order, it will spit out a real-time quote right then and confirm that that's what you want to do. Now, there's still a little risk before you actually hit enter that the market price could vary from what you just said. So you put in $50 a share, you're buying 100 shares, and you hit execute, and it goes out and tries to find a buyer. I've never had it really very much, but theoretically it could. Theoretically it could be $51 or something, and cost me an extra $1. But it usually does not happen that way. Things are executed so quickly, especially in popular stocks. Never had a problem. Now, what you can do if you've got a volatile stock, you can say, I got things to do. This stock is, it's $50, but you look at the day's range and you see that it's gone from 48 up to 52, and it's being very volatile and spiking around, and you want to buy right now, but you're like, I don't want to, get ripped off here. I don't want to buy on one of these little peaks. So I'll put in a buy order for, let's say, 49, okay? And then it'll ask you, it'll generally have the acronym, but they're pretty user-friendly, but it'll say something to the effect of GTC, good until canceled, which means that order is typically good for 30 days. Or you can specify end of the trading day. But anyway, let's say you put in an order, I want to buy 100 shares at, 49 GTC. And what it will do is that order will not be executed. It will have it floating out there in the ether, have visibility to buyers that you're willing to, or to sellers that you're willing to buy at 49. So let's say there is some volatility, and all of a sudden the price, comes down and going down towards 48. But anyway, once it crosses that 49 threshold, your limit order became a market order, and now boom, you're in the market buying it at that price. So again, there's microseconds in here, nanoseconds, but you'll probably get right at that price that you offered. There's probably something in the small print that means that there can be variations, but typically it's right at that price. And especially, if it's a widely traded stock, that's not normally an issue. And then you can also do a stop order. So related to a limit order, but what you do in this case is, let's say we're holding that stock, and it's pretty volatile. You bought it for $50 a couple of days ago, and it seems to be going up, but it's going up and then down. And right now it's trading for, like, say, 53 or 54. And you're thinking, man, my goal here is to make $5 a share. As soon as it gets to $55, I want to sell. And again, I got things to do in my life. I'm not going to sit here and watch it all day, so I'm going to put in a stop order. As soon as that price gets to $55, I want to sell. And boom, the price, if it happens to get to 55, your order becomes a market order and it's executed. So if it never gets that price, then your can probably just expire. So let's say you're going on a trip, you're going overseas, you don't want to watch the market, but you can't watch the market, or you're going to be in different time zones. You can just say, this is what I'm going to do. Especially here in Alaska, everything's going to be 4 hours different, right? The markets, they're open up here at they close it at noon. Noon is 4 o'clock on the East Coast. So every day at noon, if you're going to sell mutual funds or if you're going to sell some stock, by noon it's over. And unless you're getting up at 4 o'clock in the morning, you're not there for the opening. 5 o'clock as well. So I can't remember if it opens up at 9 or 10. But anyway, I'm usually more a factor with the closing. So long-term investors and short-term investors, that whole business we were talking about, getting in and out, that's obviously a short-term kind of strategy. For most of you, if you believe in the health of the company and if everything's going well, you may be in a buy and hold strategy, or you may evolve. You may be a short-term trader and the price starts to tank on you and you may all of a sudden decide holding it. This other thing, though, dollar cost averaging, that's pretty, that's a good tactic too, and it's, the way most people buy anyway, because not everybody has these huge chunks of money. Most people, if they're new to investing, may invest, say $250 or $500 a month or something like that. And so if you're getting into the market every month at the same amount, you're dollar cost averaging. And so these burbles and volatility in the market doesn't really affect you too much because you're more concerned with the overall trend. Dividend reinvestment is standard what happens. So what will happen if there is a dividend or even capital gains being paid, if it's a mutual fund, but what we're talking about here is stock. So in a stock dividend situation, if they pay an annual dividend or quarterly dividend, you can just arrange to have that dividend reinvested. So which means that you buy fractionally more stock when that happens. So this is kind of one of the exceptions where, I can't buy, 0.239 shares of stock. I can't put it in order like that. But when I have dividends coming back, they will go ahead and use those fractional things to buy slightly more stock. And usually if you're a long-term investor and you're not concerned with, generating income, you're concerned with putting money in an investment rather than taking it out, you'll probably want to do the dividend reinvestment. So day trading, kind of that, watching something go from, day trading is within the day. And like I say, there's always a bunch of people who jump into day trading, especially when the market's very bullish, when it's going up, and people think they can't lose and they think they've got some sort of insight into the market. But usually those people are the first to go once the market turns around, and then they realize that maybe it's not so much skill, maybe it's just the overall market. But you had, back in the different times, the dot-com bubble and all that, just preceding that, you had all these places, spring up, and people were quitting their jobs, and they were just in there, day trading, making money on stocks. And anyway, there's only a few of those guys who truly ended up being talented, and most of them just ended up losing everything they had. Buying a stock on margin, I don't recommend that, leveraging. Now, again, that's why I like real estate, because that's very common to do in real estate because, it's a much more secure asset. But buying stock on margin, if you try to do that, first off, you have to be approved. You have to show some net worth. You have to do some other things because the brokerage firm knows that, a lot of people who do this tend to lose money. Selling short, this is when you think a stock is going to go down, and so you sell the stock at a certain price. And anyway, it's more complex, but not something that's like a hedge fund manager kind of move. When you're selling stocks that you don't own. And trading in options. Out of all of these, day trading can be risky, cannot be. Depends how aggressive you are. But if you really have that kind of gambling, speculative urge, trading in options is probably not a bad way to go. It's far, far better than trading in futures. Because again, in trading in options, you buy an option. Let's say, in a simplistic example, you expect you can do it for something short. Let's say you expect, a stock is trading right now for $50 again, okay? You expect that stock to tank. So you buy an option to sell that stock, for whatever, sometime next summer. You buy an option to sell that stock for $50 next summer. And you pay somebody a fee. There has to be a market. Somebody else has to be on the other side of this. It's always a zero-sum game. But anyway, somebody buys that, says, you know what, I think that stock's going to stay level. I'll take your fee, say it's $300 or whatever. You're putting up some money that's just a fee to buy this option. And if, let's say next summer, that stock is still trading at $50, well, there's no value in your option. You aren't going to exercise that option. You're going to let it expire worthless. Or if that stock is trading for, $53 a share, again, you're not going to exercise that option. But if you were right and that stock is now trading for $45 a share, and you have the option to sell that stock at $50 a share, well, you're going to make $5 a share, and somebody's going to, the guy on the other side of that bet is going to take it up. So, this is pure speculation. It makes for a more efficient market, but there are economic reasons to do this. Again, we get back to that example I used, like in, it could be jet fuel, it could be sugar, it could be whatever. You get these big companies that are dealing with commodities that are volatile, and they don't like that volatility. So they will gladly pay you, let's say sugar's going for $1 a pound. They'll buy sugar for delivery next August for $1 a pound. And somebody takes that and says, okay, I can do that. And if sugar goes up to $3 a pound, guess what? That company still gets to buy that sugar for $1 a pound. If the sugar's traded for 50 cents, these guys still got to pay $1 a pound to that guy. So anyway, it just takes that financial guesswork out of it for the manufacturer, and people will obviously pay for that sort of predictability in the market. But the people who are involved in that, this is beyond investing. This is into speculation. So most of the stuff is kind of, this is not the money that you're using for your retirement. This is the money that you've met all your savings goals. You put away your money. Your credit cards are paid off. But somehow, just luck would have it, you got $500 left at the end of the month. I want to do one of these get rich quick speculative investment, and that would be one of them. Bonds. So not everything I'm going to say, anybody who tells you to invest in bonds today, on long-term bonds, is not, they don't have your best interests at heart based upon the interest rates. But like I say, 5 years from now that can change, or short-term bonds, there may still be some deals out there because your exposure to trends in interest rates is not going to be that great. Right now, interest rates are quite low. They're talking about negative yields even. So anyway, it just makes anything you sell, it's going to be a difficult transaction to get rid of a low-yielding bond in the future. Describe the characteristics of bonds. Corporations issue bonds. They don't want to dilute the value of the company. They don't want to sell shares, because when they sell shares, they're actually selling a chunk of the company. A lot of companies will do that. That's how they generate wealth. But in this case, for whatever reason, let's just say the corporation doesn't want to do that. They just want to make a simple loan. They don't want to go to a bank. Banks can do loans, but not these big, huge, mammoth loans a lot of times. These guys will go to an investment bank that will have them put together a bond issue to the general public. And then there can also be, state, federal, governments doing bond issuances. So it's it can be issued for a number of reasons. We also get into tax-free bonds, muni bonds, other things. But anyway, just think of bonds as a loan. So, evaluate bonds when making an investment. So we'll talk a little bit more about this, but they're 5 seconds old. Structures are clean. So we talked about how this works. It's a loan, written pledge to repay that money with interest. Usually denominated in amounts of 1,000, but you typically would buy a larger bond. Let's say you get a $20,000 bond. That means you give that company it's worked through an intermediary bank, but they get your $20,000. They pay you a bond dividend each year. Usually it's split up into monthly payments or quarterly payments. And then at the end of the term, let's say, a 10-year bond, they give you your whole chunk of change back, your whole 20 grand back. So not only do you get your money back, but you got that dividend over the whole time. So it's not a bad deal. Here they're doing over a 6-month term. Legal conditions, bond indenture, those are just kind of the rules they're playing by. Trustee is the one who is the intermediary, typically a bank that executes this yield, but you can buy them on the secondary market as well. They may have a major expansion going on, just regular business activities. They may not want to sell stock right now, and also financial leverage when they've they want more money to expand. Also, certain advantages to the corporation itself. Paid to bondholders is tax deductible. Debenture bond. So debenture it's a loan. You don't own a chunk of that company, but it's backed by the company. But if that company goes out of business, so wouldn't your bond. So mortgage bond theoretically should be more secure. If it's backed by real estate, but again, if the underlying people with those loans are not worthy, then that can be fraught with danger. So they're saying the interest rate is lower because it's secured by the collateral and the corporate assets, but many times that collateral, of 5-10 years ago was not so much. Now loan standards are quite a bit higher, but there's always a tendency for politicians especially to get in there and try to lower those standards for loans, trying to make homes more affordable, but it actually degrades the value of the investment. Subordinated debenture loan. So subordinated is never a term you want to hear. That means that other people have superior assets to you. That if things basically hit the fan, that you have to kind of get in the back of the line behind the other folks. Convertible bond. Yeah, this is where you can convert it to stock. Again, not something I typically do. But you'll hear a lot of the pundit guys on the radio and stuff talk about asset allocation and how much you should have in bonds and stocks, and but a lot of their advice is from when bonds were a more attractive investment. Right now, my bond holding would be quite low, at least in the long-term bonds.
What percentage would you say?
Right now, my bond, I have no bonds at all. I'm not a big fan.
Well, for the majority of people I mentioned, they're going to be, the majority of people in this fund, or they're going to have someone else invest their money.
Mm-hmm.
So, meaning
that would be kind of a test right now. If somebody said, "Oh, you need to buy some bonds, you need to buy some of these long-term bonds," I would go someplace else in a heartbeat right now. But when it gets to a normal status, bonds. There are advantages to bonds. They claim to be a bit safer, and short-term bonds can be quite good. But when they talk about the security of like the mortgage-backed securities, that ended up being a fallacy. You know, a lot of those people lost money. So,
right. But like a realistic situation, I would imagine for a lot of people in this class, they're gonna go get a job. 6 months later, they're going to be offered the opportunity to put their money into a 401k.
Right.
And then that 401k or something like that, and then that money will the individual has control over that money. Where it's diversified.
Right.
Whether stocks or bonds. And then at that point, when you're diversifying it, you would say, if the economy is the same as it is right now, go put it into stocks instead of bonds.
That's how I would be. I would be in the equities.
No bonds.
Well, or you can actually, you know, we'll talk. You know, this is just, you know, stocks and bonds right now. We'll get into mutual funds later, but when you're talking 401ks, you're typically talking mutual funds, right? And you can get what they call these life cycle funds, and you'll say, okay, you know, you basically do the math. Okay, I'm a college student. I'm 40 years from retirement right now, and the nature of those funds is they'll basically do an asset allocation. They'll say, okay, this person is 40 years out from retirement right now. You know, the weight of this fund right now is going to be in high growth securities, you know, in equities primarily. Okay, now this person, he's 20 years from retirement. You know, they're going to do this like in increments of probably every 5 years, but they're going to switch around your asset allocation. And by the time you get to be older, they're going to say, okay, this person, all things being equal, should probably be in bonds now, you know, something that's paying a dividend, you know, an income or income stocks. But right now, yeah, I would not buy bonds.
The class project.
Yeah.
You know, as far as
sure.
setting up that person to graduate 5 years down the road.
Yeah.
Where is that person going to, you know?
Well, yeah, but that could actually be part of your class project. You could go on there and you could just type in the search term in Google or anything else, life cycle fund. It's going to come up with a zillion options, and look at those and say, you know what, you know, I've got a family to raise, I got a job to do. You know, I know enough to put money into a tax deferred account like a 401k, but in terms of trading stocks, you know, there's a lot of people now who don't even like to do that. They're like, the small guy gets beat up. It's the institutional investors are you know, squishing the small investors like a bug, and so I'm not going to be part of that. I'm going to buy into a life cycle fund, and I'm going to watch that. So let me. I'll push through these slides a little bit, and then the last thing we'll do today is I'll do exactly what I said. I'll go on the internet. I'll show you a life cycle fund, and it'll give you a bit of an example and another option. You know, you can be actively involved. The reason why, you know, I'm kind of probably more actively involved in stocks, trading and stuff, kind of hands-on, is because I kind of enjoy it, and it's more motivation. You know, putting money in a bank or in a 401k can get to be kind of boring, and so I might be tempted to fritter away that money on a new snow machine or something. But if I'm working towards a goal and it's money that I'm going to get to kind of speculate with, I'm kind of driven to save that money to do that. You know, get rich quick schemes. If it's money I was going to, you know, basically piss away on something else stupid, you know, I don't need another new car. I haven't had a new car in years and years. And I've got a bunch of old ones, but it's just something I kind of enjoy. So whatever it takes to get you involved. But if you're like, you know, kids playing hockey and you got your day job and I want to keep this easy, I'm going to find a good, solid company, a mutual fund company. I'm going to invest in one of their life cycle funds, and I'm going to watch my profits. I'll check in every year when I do my taxes and see how it's going. But other than that, I'm going to be kind of hands off. That's completely fine and potentially more profitable in the long run, rather than getting in there and, you know, chasing get-rich-quick schemes, which is not, I can tell you. The reason why I'm not a big advocate of penny stocks is because I've lost every dime I've ever put in penny stocks. It's not huge, you know. The kids all still hate, you know, but again, I've lost some discretionary income, let's just say, to penny stocks. And but man, fun. I mean, but it's like betting on sports or going to the track or something. It's not a positive behavior, you know, something should be avoided. High yield bonds, yeah, that sounds like something I want to be involved in, right? until you figure out that these are also called junk bonds. So it's a marketing. One man's high yield bond and somebody else's junk bond. But this is, you know enough about personal finance to know that if something is paying a huge interest rate, don't be shocked when it pays no interest rate or you lose it all. The reason why, interest rates are paid based upon what's required. And so if you were making a ton of money off a bond, that's great while it lasts, but when it goes, it goes. So junk bonds, they've got different bond ratings, and as they get, more extreme, bonds lent on the Greek government are definitely in junk status. And there's other things that are, and the problem with bonds too is it's complete grade inflation. AAA rated bonds, whereas a B bond is C bonds are definitely junk. You know what I mean? So the grading scale is very subjective. Well, they're only rated single B. That's not bad. No, that's pretty bad actually. But anyway, there's companies out there, Standard & Poor's, Morningstar, other bond raters that you can look at. Another thing with bonds too that's kind of nasty is this call feature, right? If they say, let's say it's not going to happen in this economy, but let's say for some reason bonds aren't selling, interest rates are high, they offer a bond that's paying a 10% yield, and you're like, yeah, this is great. I'm going to jump on this bond because it's exactly the opposite of the situation that I'm describing where interest rates are low. So you're going to lock in this 10% interest rate. Everything's great until it's got a call feature. And so when interest rates normalize, say interest rates go back to 3%, the corporation calls the bond. They just say, guess what? We're calling that bond back. Here's your $20,000 back. The deal's off. So if it's got a call feature, it can be kind of a drag. And there's usually some requirements there, though, not for first 5-10 years. Anyway, most corporate bonds are callable, so keep that in mind. Sinking fund, that's just how the corporation's going to pay that money back to you, so not really a concern to you. Serial bonds mature on different dates. You can have different maturities, so one bond matures in 2020, the next one 21, whatever. But they can be given, it's not just a lump sum date. Interest income, so this is the reason why you're doing it. Zero coupon bond, bearer bonds, anyway, different forms of bonds. I'm not going to, go too much in the details, but it just depends on how you're going to be paid back the money. We won't, spend a whole bunch in this. But just like stocks and bonds, if you're actually holding the paper, you're doing something wrong. These things are traded electronically. If you actually have the stock certificates in hand, those things are at risk. You should not have those. When you trade stocks back and forth, nobody sends you a stock certificate. Those are more like museum pieces. So this dollar appreciation, now, again, I don't like their term there, dollar appreciation. It can also be dollar depreciation, which is more common now. May be able to sell the bond someone else at a higher price if the interest rate is higher than the market rate. Well, guess what? The interest rates right now are very, very low. So the likelihood of this situation that they're describing is quite low. The likelihood of higher yielding bonds being out there in the market, and you're 1-2% bond, you're trying to sell it. I mean, it's a toad. Nobody wants it. Or if they want it, they want to pay you, $15,000 for your $20,000 bond. So anyway, bond amount will be repaid at maturity. So you can be very stubborn here. You can say, you know what? They're only going to pay me $15,000 for this bond that I paid $20,000 for. I'm going to keep it till maturity. Well, you're not really winning. What you're doing is you're keeping that money, your $20,000 locked up in this, 2% loan. So do what you like, but you're not really getting one over on anybody. The best thing is to watch interest rates and buy bonds, long-term bonds, in relation to the interest rate. If interest rates get back up, bonds are probably a good value. Can be. Mechanics of bond transaction. Yeah, not a big deal. Most brokerages will handle this. discount brokerages. So again, not a big deal. You have to keep track of through records. Obviously there's going to be tax documents generated, but not a big deal. Most brokerages will keep records for you. You print stuff out at the end of tax time. You can keep a PDF copy saved somewhere. So it's fairly seamless. But you don't have to go to a full service brokerage firm, nor do you actually go to the company that's offering the bond. You use that intermediary. Sometimes there's these muni bonds, which people are like, oh man, it's tax-free. It's got to be great. Well, as we know from earlier examples, a lot of times when it's tax-free, it's at a reduced interest rate. So, you get out of it what you put into it. Again, they'll sell those rates, they'll sell those bonds at what they have to. They'll only offer as much yield as they need to in order to get people to buy them. T-bills, treasury notes. Again, these are technically bonds, but again, the interest rates on these are less than 1%. So we reviewed these when we talked about, savings accounts and other things. Treasury bonds, yep. Some of these savings bonds and other things like that, they're kind of neat to give to kids as gifts and stuff, but I would not put them in the serious investment category.
Are those all digital only, or are those on paper?
A lot of times you can get those on paper, and that's why they're kind of, but they're, it's kind of like giving ancient stamps or something. I'm not a big fan. It's not a super serious investment on my part. And then they made some modifications back when interest rates were screaming, Treasury and inflation protected ones, but that hasn't been, and high inflation hasn't been a factor for going on decades. Fannie Mae, Ginnie Mae, Freddie Mac, some of the big mortgage bank things, they're like pseudo-government agencies. Again, used to be bulletproof, used to be the investment you wanted because they had collateral behind them. And then when they, mortgage-backed securities, it all fell apart. These guys have to do a lot to reestablish themselves. Federal debt issues. So, again, they can be offered by other federal agencies and munis, offered by the local level. So either general obligation or revenue bonds, tied to a specific project or whatever. They're a fairly low risk investment, but again, some of these municipalities, Chicago and places like that, certain municipalities are in serious financial shape. Again, they can be callable. The interest rate is typically pretty low, though, so you have to do that calculation to figure out whether that tax advantage is really there for you. And if you're in a low tax bracket, it may not be worth it. So we've done this equation quite a few times. Tax rate, so it depends on your tax rate. This person's a 28% tax rate. In terms of evaluating, obviously just the internet is not a good answer. You can get rough information, but what you want to do is all these .com type websites, not a super big fan of these ones, but let me get to the rest of it. Moody's, Standard & Poor's, and Fitch. These are the guys that you would rely on. They're going to be more technically written, but if you're buying individual bonds, you need to be up to speed on that. You need to understand that. But these are the guys who actually do the ratings. Fitch will do the ratings on, entire countries and all. And how to do the bond yield calculation, annual income, current yield of bond, face value. So we've done this a few times now where you just do the calculation. It's pretty easy, but that market value is the one big determinant. and that's what's going to kill you. The market value is established by the competitive nature of the interest rate that your bond was issued at. So if your bond is issued at a very low interest rate, your market value is going to be quite low. So let me, real quick, like I said, so just, there's going to be other trade names for them. But Vanguard, Funding Circle, Growth Funds. Anyway, every one of these guys, look at this. Can get any simpler. Investopedia, they're just an advice kind of company. Let's look at Vanguard. TIA, Kraft, they're the educational one. So it depends kind of what sector you're in. But some of these guys will expand this out. So Life Strategy, Life Strategy Growth Fund. They'll have their fees, and then they'll, look at when you retire, and it will adjust as you go. So, target retirement 2010, 2015, 2020. So, these people are fairly old in their ways. Let's go up here to, what's a reasonable retirement age for you guys? Let's say 2050 looks like where it stops. People designed to retire between 48 and 53 the years. Diverse portfolio of stocks and bonds, so you're going to have that asset allocation within this fund, right? Handles investment selection, automatically adjusts between stocks and bonds, becoming more conservative over time. So just what I said, you know what I mean? As you get close to retirement, they're going to get you out of stocks, more speculative ones. They're going to get out of any sort of, not junk bond, but, stuff that was less than AAA rated stuff. And but by doing that, the yield is theoretically going to be reduced a bit as well. So these fees, minimum initial investment, probably that initial investment, if you actually sign up with an account with them, that will probably be eliminated. But anyway, you can go in any one of these and type in life cycle funds, and if that's your strategy, that's one way where it's going to be kind of managed. And that whole asset allocation, okay, I'm 20 years out from retirement, where should I be right now? Well, that's what these guys strive to do. And so you can sign up that from the get-go. I'm not, depends on your situation. If you're a hands-off kind of person, that might be the way you want to do it. Here they've actually got one for people already in retirement. So this is going to be, current income and some capital appreciation. But obviously their priority is income. But if you get actually into the details, into the weeds, it should be, hyperlink, and it'll go through and kind of tell you their strategy. At some point, if you actually want to invest in this, they would, make you basically sign off, acknowledge a prospectus, and then you're good to go. But I'll tell you what's under it, the summary, the product. I mean, they're selling something. And like I said, this would be the actual prospectus. So this is all kind of marketing wash kind of stuff. The prospectus is going to be the kind of the rules of the road, and it's going to be, this is what, the guy needs to do. And it's going to be a lot longer legal written document, but that's kind of where you got to go if you're going to jump into that, because they can't sell you until you acknowledge that you've read that prospectus. Questions on that? We'll talk more about it. We're going to be in the mutual funds, I believe, next week, and we'll look at that. But there's plenty of options for people who don't want to get down in the weeds with it. Sound good? All right. How did we get here?